Hello, good evening. How are you? I hope you're doing well. Okay, so let's start and begin with our crash course for the taxation over here. I am your instructor who is going to take you along this journey as far as revising and taking you along as far as this crash course is concerned. And before I start, I would just like to know that this is the first time you are preparing for the paper, or have you attempted the paper before earlier as well? So if you just tell me in a quick response, I will be able to share more details about the course plan that we have over here.
Hello, sir. Actually, this is the first time I'm sitting for the exams.
Okay. And you took the regular classes, or you were preparing on your own, and now this is the first time you have opted for the classes and you just thought to revise the course and all.
Um, Actually, I took the class from another teacher, but I just couldn't really grasp the lectures, so I just chose for the revision course.
Okay, okay, okay. No problems, no problems. I
Once
got it.
this
I
is
got it.
complete, then I will know which areas.
Okay, done, 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 done. Okay. So basically, the line of action that I have, and before going towards the line of action, basically your voice was distorting as well, and it was a bit breaking up as well. So if my voice breaks up or something, do let me know straight away, because I have the other internet connections as well, so that if I have to switch, I can straight away switch to some stable network. Because um, somehow, some way, because of the dependency of the IT, this is something you will agree as well, that at times one connection is working better than the other one, right? So if you feel like that my voice is breaking or something, do let me know so that I can switch straight away as far as my internet connection is concerned. Now, coming back towards the plan and all, the point is, as far as the structure for the crash course is concerned, you must have been shared with the link or with the Academy's portal as well, where I have the recorded lectures as well. And then I have these, live sessions as well. So in every class, you are required to go through the recorded lectures, which I have already shared, so that you revise the basics over there, right? So that when we are sitting over here in this crash course now, face to face, one on one, we straight away practice the exam kit, the questions that we have, or the past exam questions that we have, so that at the end of the day, apart from the knowledge, application of that particular knowledge is really very important over here, right? I mean, if we know how to apply the knowledge, only then we will be able to, get along, or we will be able to get it done, right? So I hope you have gone through the videos that I had shared already. I mean, via the Academy's portal, you have gone through those multiple videos as well. And those videos were over here just to ensure and make sure that you have revised the basics, the basics, right? And then, after revising or getting through as far as the basics are concerned, we move forward. Done. So over here today, we are going to have a comprehensive practice as well, and we are going to practice the questions from the exam card. So let me straight away start. And before starting, just a teeny tiny reminder over here that the WhatsApp groups are going to be created as well. So if you are practicing and you come across any problem or something, straight away take up the picture of the problem, straight away, take the picture of the question, and straight away send me a WhatsApp. I will be more than happy to assist you and guide you. And my support is going to be continued with you till you're not done with the paper, till you not get through as far as the paper is concerned. So I am going to be available 24/7 onto the WhatsApp as well. Now, before we start, this is a kind reminder regarding the exam pattern questions basically that we have. Basically, we have a section A over here. In section A, we are going to have the 15 MCQs. They are going to be of 2 marks each. The total is going to be 30 marks over here as far as the section A is concerned. Then we have a section B in which we are going to have 3 questions, and they are going to be the MTQs over here. MTQs are the multi-task questions, right? So you'll have the MTQs over here, and these MTQs are going to consist of 5 questions each as well, right? So each MTQ multitask question is going to have 5 questions in each, and the total is going to be the 10 marks for each MTQ, and that is going to be the 30 marks as well. So each MCQ is of 2 marks in the section A. Same like in the section B, you will have a 2 mark MCQ as well, but you will have a set of 5 MCQs in one single scenario based questions, right? So you will have to read the scenario and you will have to address the problem over there. Like, for example, in your childhood, like, in our 6th, 7th, or 8th grade, you must remember in the English, we used to have these unseen paragraphs. The whole paragraph used to come, and then we had the questions from that paragraph. After reading the paragraph, we used to answer those, right? So same is the case over here in the taxation. In the section B, you are going to have the 3 unseen paragraphs over here. A whole scenario is going to be there in those 3 separate individual standing questions, right? So you will take on those questions one by one. You are going to read the scenario, you are going to straight away hit on it, and as far as you are going to reply, and you are going to write or compute the answer for each and every question over there. Then you have a section C over here. If we talk about the section C, we are going to have 1 question of 10 marks. So that's going to be 10 marks. And then you will have 2 questions of 15 marks over here. That's going to be 30 marks as well. So now if I do the total, the math says that we are going to have 100 marks paper over here. This 10 mark and this 215 marks question, the main focus is going to be on the income tax and the corporation tax over here. The main focus of the examiner is going to be on the income tax and the corporation tax over here. And overall speaking, if I talk about over here, normally this 10 mark question, sometimes this is of the income tax, and this is going to be of the income tax question where the examiner has given you multiple questions over here related to the income tax, and then 1 question over here explicitly for the income tax as well. Then in that case, you will have a 10 mark question for the income tax over here. Otherwise, if the examiner has not given you a full-fledged question over here in the section B, then he is going to give you a 15 marks question for the income tax, not a 10-mark question, right? In the 10-mark question, you can have the income tax, you can have the capital gain tax, you can have the question for the VAT as well, you can have a question for the inheritance tax as well, right? So these are the areas which are normally going to be there. But as far as the 15-mark question is concerned, this is definitely going to be from the income tax and the corporation tax over here. So normally if I safely sum up one thing over here regarding the format of the paper, I can simply say that you can expect to have 115-mark question related to the corporation tax, and for as far as the income tax is concerned, you will be having a question from 10 to 15 marks at least over there in the section C over here. Right, so this is the whole paper, and the best part is the Finance Act that we are going to have, that is going to be of the 2024, which is going to be applicable over here. You are going to be provided with a tax table in the paper, right? So you don't have to memorize as far as the rates are concerned, because these are the ones which are going to be given to you in the paper. I mean, you just have to consult as far as your tax rate table is concerned, and then you can consult it up, and you can look from as far as you know the rates are concerned, and then you can simply apply them up over there, and then obviously you can straight away go and get through as far as the question and everything is concerned, right? Okay, so this is the whole debate over here regarding this, and if I now move forward, we are going to have, okay, this sheet was supposed to be over here. Now, let's just go over here. We have this question number 93, and this is the Philip and Charles over here. This is from the basic income tax computations and the employment income that we have over here. I hope you must have gone through as far as the basics are concerned, although the points basically I will be having over here, I will be discussing regarding those points as well. And primarily we are going to focus on as far as the computation and everything is concerned. Now, overall speaking, this question over here, this is going to involve as far as the income tax computation of two individuals is concerned. They are going to have their own individual circumstances, which you are going to blend in as far as the questions are concerned. And then you will look forward towards how their income tax calculations is done, how their NIC calculations and all and everything are done over here. Right, so let's start. Okay, so let's start. Philip and Charles are father and son. The following information is available for the tax year 24-25. We have the information regarding the Philip, we have the information regarding as far as the Charles is concerned, and then we have this combined information over here, right? During the year 24-25, Charles made a gifted donation of 800 to a national insurance charity as well. Sorry, national charity as well. And then Charles has been a member of the personal pension scheme since May 2022, right? So this is something which is related to the Charles over here. So for as far as the Philip is concerned, we have the first question over here. What is Philip's income tax liability for the tax year 24-25 over here? And as far as the Philip is concerned, Philip retired at the age of 55. During the tax year 24-25, Philip received the pension income of 15,000 and the building society interest of 14,600 over here. So the income for the Philip, if we look over here, are just one 15,000 over here, and one is the 14,600 over here. Now, the question has explicitly asked you over here that what is the tax liability, not what is the taxable or the total taxable income. It's asking for the liability over here. So we will have to create a whole format over here, and that format is basically going to be of the non-saving income. Then we have the saving income, and then we have the total income as well. So we are going to have the currency signs. So we have this pension income over here. Okay, as far as the pension income is concerned, it has the pension income of 15,000 over here. And before I go, I just have to do 1,000 separator, and I am going to use the decimals over here. I don't need, and then the negative numbers are going to be with this one over here. Okay. So we have the, okay. So we have the pension income 15,000. Then we have this in the total as well. After the pension income, I have the building society interest. So building society is going to be in the saving income, that is 14,600. So that's going to be over here. So now if I do the total, I get my total income over here of 29,600 over here. Now, we all know that we have to minus the personal allowance. Personal allowance is 12,570 still over here, right? So we are going to deduct it. So we are going to get our taxable income over here as 17,030 over here, right? So this is the taxable income that we have over here. Now, obviously, we have to calculate the income tax over here, right? As far as the calculation of the income tax is concerned, first thing first, we can, talk about this taxable income over here, and this personal allowance. We all know that the breakup of the personal allowance is that this 12,570 which we have deducted in the total income, this is basically the hierarchy is that first this is has to be deducted from the non-saving, then saving, and then you move forward into it now. So that's going to be 12,570. So if I go and I do the totals over here as well, I get this over here 24, and then 14,600 is over here. Now, if I go as far as the calculations are concerned, for the non-saving income part, I just have 2430, on which my basic rate is 20%. So I get simply 2430 into 20% at 486 over here. As far as the saving income is concerned, right? As far as the saving income is concerned, okay, if you guys remember or not, okay, for the sake of the revision, let me have it over here for you. Just 1 second. Here we go. Yes. And here we go. Now, this is the tax table, which I've just extracted from your past exam papers, right? So this is the basic one over here. The 20% is the normal one over here. When I go into the saving income, the nil rate band, right? So the basic one is, oh, okay. Okay, so the basic one is we have the saving income nil rate band 1,000 over here. For the higher rate taxpayer, this is the 500 over here, right? And for the dividend, this is 500 over here. Now, if I go over here, my saving income, right? If I go over here, my saving income is basically this 14,600 over here, right? So saving income, if I take up the breakup is going to be, okay, so for the first 1,000, it is going to be taxed at 0%, that's going to be 0, right? Then for the a starting rate of 0% applies to the saving income where it falls within the first 5,000 of the taxable income over here, right? So my non-saving income is just 2430 over here, right? So for the first 5,000, right? For the first 5,000 minus 2430, right? So it falls within the first 5,000 of my total income. Now, look at the amount over here that I am going to get over here. Okay. So this one, this amount, that is, let's just calculate over here for a second to show you guys what I'm saying. 2570. So this 2570 is going to be multiplied with 0% as well. So that's going to be 0 as well. Now the point is for the saving incomes, if you remember that if the total income of the individual is XYZ and the saving income falls in the first 5,000 of the total income, like for example, in the whole year, you earned a total income of 7,000. In the whole year, you had a total income of not 7,000, but let's say because 12,570 is the personal allowance as well. Let's say you had a total income of like 14,000 over here. And the breakup of the 14,000 is that you had some non-saving and then you had saving income as well. After deducting the personal allowance, you are left with the saving income of 2,000 over here. Now, there is going to be a zero tax on 2,000 because your total income that you have, if in the first 5,000 figure, in the first 5,000 figure, that income contains anything from the saving part, that's not going to be taxable, right? That is not going to be taxable over here. Let me explain it to you over here as well. Like say in case you have a total income of 30,000. This total income has a breakup that you have 15,000 from non-saving and then you have 15,000 from saving over here. So the total income is 30,000. Your personal allowance is 12,570. So your taxable income is going to be 17,430 over here. Now, this 17,430 has a breakup like this: non-saving and then the saving. You had 15,000 over here, 15,000 over here. From this, you minus the 12,570. So you are left with this 2430 over here and 15,000 over here, right? So this 15 plus 2430 is 17,430, the total income that you have. Now, this total income, if I say that what is the breakup of first 5,000 that you have of this income? First 5,000 of this income is 2430 from non-saving, and then this 2570 from saving income. That is how you get the 5,000 whole. Now the standard says, the law says, if in the first 5,000 of your income, you have any amount from the saving income, it is going to be taxed at 0%, right? So in the first 5,000, if you have any income, that is going to be taxed at 0%. And this is same what it is written over here, that the starting rate of 0% applies to saving income where it falls within the first 5,000 of the taxable income. So that is why after this 2430, I just took a difference over here. I had this 2570 on which I have to take this 0% over here. Then on the 1,000 of the income, it is going to be taxed at 0% as well. Now the remaining amount, which I'm going to have, this is 14,600 minus 2,570 minus 1,000. I get 11,030 over here. And then for the saving income, the band rate, the normal band rate is going to be the 20% over here, right? So I am going to have this 20% over here. So this is going to be 11,030 into 20%. So that is going to be 2206 over here. So the income tax liability is going to be the sum. That is 2692 over here. Okay, I'm going to get it over here. Okay, and this is the whole question. So I have to bring it down here. Okay, so let's just take it here and let's just take it here, right? And let's put a line over here. So the answer is this 2692, option A over here, right? So that's how it was supposed to be done over here. Now, moving ahead from here, we have the part 2 over here. Charles is entitled to a personal allowance of dash during the year. Let's just go to the Charles. So we have Charles is self-employed and his tax adjusted trading profit for the year ended on 112,400. Okay. Now we have to adjust the personal allowance over here. And it's not saying over here, but we have this portion as well for the personal allowance. Let's copy it up. So the weight adjusted income, net income is 125, 140 or more, the personal allowance is reduced to 0. So we have to adjust the personal allowance as soon as it crosses the limit. The income limit is basically 100,000. So as the income go beyond it, we have to adjust the personal allowance. Now, this is the Charles. So we have the personal allowance adjustment over here. So basically the personal allowance is 12,570 over here, right? We have the total income. The total income is 112,400. Oops. Okay, so total income is 112,400. Less we had the donation over here as well. I did happen to read. So during the year, Charles made a gifted donation of 800 gross amount. Yes, so we have the relief for this as well. Right, so we'll have this 800 over here. So we will have the annual net income over here. So that's gonna be 111,600 less income limit, that's 100,000. So a reduction in personal allowance is going to be the difference between the two into 50%. So 11,600 into 50% is going to be 5,800 over here. So we are going to have 6,770 over here as our answer. This one, this part B, right? So that is how the personal allowance is going to be adjusted, because we have this personal allowance of 12,570. So we have this our higher income over here. So we had to do this adjustment, and this is something we always do in all of the questions where the income is higher than the 100,000 but lower than the 125 limit, basically, that we have, right? And then we have the question 3 over here. What is the amount of class 4 NIC or National Insurance Liability in respect of Charles for the tax year over here. Now, if I go with as far as the NIC is concerned, okay. So we have to get for the Charles over here. So okay, Charles has this 112 400 over here. Then during the year 24-25, Charles made a gifted donation over here. And then he has been a member of the personal pension scheme. He made the gross contribution of 25,000 over here. That's it. This is what the whole information that we have over here. So basically, if we go with this one, basically, you know, overall speaking, we are going to look at, okay, fine. This is gonna be straight away over here, now. Okay, so this is 112 400. So I can simply have for as far as the class 4 NIC is concerned, I have this limit of 50,000 to 70 over here, from the which I will minus the 12,570. So technically I have 50 to 70 minus 12,570. So the first basic amount that I have is the 37,700. So on that, I am going to have the 6% over here, right? So 37,700 into 6%, I get 22,621. And then my total income is 112,400 minus this basic threshold of 50,000 to 70. So I get 112,400 minus 50 to 70. I get this 62,130. And on this, I am going to have the 2% over here, right? So with this, I have this 1243. So the total amount that I am going to get is 3505 over here, right? So this is basically the straight workings that you do over here. Okay, now for this, yes, let me show you basically, like, how I had this whole clue with me that what am I supposed to do over here. I mean, if you don't remember the rates over here, this is the national insurance contribution, and this is going to be there in the tax table that you have, right? So if I go into my class 4, from first $1 to 12,570, we have a nil rate over here. Now for the personal loss, we don't get any. And then if the threshold limit is 50 to 70, see, so I knew about the limit because this is something we have memorized via the practice and all, but you can look straight away as far as the rate table is concerned. So look at the 5 to 70 that we have, minus this 12,570 from that, right? So you are going to have the 6% over here. So I straight away had the 6%. And then whatever the amount over and above this 5 to 70 that I have, that's going to be at the 2%. So that is why I had this 2% over here. So 3505, this is going to be my answer over here, right? So we have this table with us as well, which basically helps us to identify that how we are going to, compute the amount over here, right? Now, so what was the total available annual allowance? Total available annual allowance to Charles for pension contribution during the tax year. Okay, now, as far as the total available annual allowance is concerned, this is the amount of the allowance that you have for the current year, plus any unused allowance from the previous 3 tax years as well. So from the previous 3 tax years as well, you have to look at the allowances as well. Provided the individual was a member of the pension scheme in the tax year. So if you are a member in the previous 3 years as well, you can look for that, amount over here as well, right? And then obviously, while calculating the allowance and all, just look at the gross payments that you have and straight away take it into account. Simple, right? So if I go up, Charles has been a member of a personal pension contribution since May 2022 over here, right? And he has made a gross contribution of 25,000 in the tax year 22-23, and then has not made any contributions over here. So over here, we have allowance for the current year. Current year allowance, the threshold is 60,000, right? And then we are going to add any unused allowance from previous year. From previous years, right? So we are going to have this one over here. Now, if I go for the previous year's working, I paid the amount in 2023, but I haven't paid any amount in 23-24 over here, because this is 24-25 now. After the 24-25, I am going to have the 23-24 over here, right? In the 23-24, you are going to have an allowance in the previous year of 60,000. Then 23-24, you are going to have the 22 and 23, in which you have 22-23, you paid an amount of 25,000. So 60,000 minus 25,000, you are going to have 35,000 over here for that as well, right? But over here in 22-23, this is not going to be 60, this is going to be 40, because at that time the 40,000 allowance was available. And then in 21-22, you are not a member over here, right? So total amount that you're gonna have over here is this 95,000 with this exception. This is 75,000 you are going to have. So 75,000 is what you are going to have over here. So the total amount is 135 over here. This one. So you will have a total amount of 135,000 over here that we have to take into account over here. Right? So that is how we are going to move forward into this over here. Right? Okay. Now, moving ahead from here, Charles had considered making payments of 6,880 into a personal pension scheme during the tax year 24-25. So for each of the following statements, let whether or not it would be true or false if he had made such a contribution. Okay. So his basic band rate for the year 24-25 would have been increased by 8,600 in relation to this contribution. So basically he had made the payment of 6,880, right? So if we gross up this amount, 6,880 divided by 80 into 100. Yup, this is going to increase by 8,600. It's true. I mean, we all know that we get the gross up of the we gross up the amounts by the 20% over here. So if it's making a net payment over here, We have to gross it up over here, right? Then his taxable income for the tax year 24-25 would have been reduced by 8,600. Now, when you pay as far as the contribution is concerned, the contribution itself does not decrease or affect your taxable income, right? Rather, you get a relief by the expansion of the tax band is concerned, plus you are given a relief at the source of 20% as well, right? So basically, if we look over here, I mean, if he had paid the amount of 6,880, he has been straightaway awarded to minus the extra 20% by grossing up the amount over there into his income over here. Number one. Secondly, his rate has been increased over there as well. So saying that, his taxable income is going to reduce, no, it's not. We don't reduce the taxable income, right? So this statement is going to be false over here. Now, HMRC would have paid 1376 into the pension fund on his behalf. And why is that? Why would the HMRC would have paid 1376? How we have gotten this 1376? Let's see. The amount is 8600 minus 6880. That's 1720. That is 1720 over here. So how this 1376? This is false. Because as far as the contribution of the HMRC is concerned, HMRC would have paid that charitable organization the difference amount over there. Why should I be having this 1376, or how the statement is wrong? Okay, then his personal allowance would have increased by 4,300 in the tax year 24-25. Now his tax allowance, how is going to this thing affect him as far as the personal allowance is concerned? And this is going to be increased, because the reason being, we have this 8,600 over here. Our basic band rate is going to increase. So when we have to adjust it up, this is going to be the 20%. So 8,600 into 20% is 1720. No, sorry, 40, 50, 50, 50, 50. 50% is what we do the adjustment now. 4,300, true. That is the 50%. Adjusted net income is by the 50%. So by 50%, this is going to increase. So the statement is true. This statement is true. Right? So this statement is going to be true over here. Right? So that is what the basic approach we have towards as far as tackling or solving these questions is concerned. Right? Now let's move forward. And let's see, what do we have in question number 94 over here? We have Kim Baxter question over here. Kim is employed as a salesperson by the Shop Soup PLC. During the tax year 24-25, her employment package included the following benefits. 1, 2, 3. Then we have the other information over here. Right? And after this other information, we have this question number 1 over here. What effect will the use of her car for the business purpose have on the Kim's taxable employment income in the tax year 24-25? Select the appropriate box from the table below over here. Okay, so we have the car for the business purposes. So let's just go over here. And this is the point number 1 for the car. Now, during the period from 1st June 2024 to 5th April 2025, Kim used her private car for business and private purposes. Okay, the private car is being used for the business and the private purposes. She received 36 pence for each business mile traveled from Sharpsuit PLC. Kim's mileage during this period was as follows. Normal daily travel between home and permanent workplace. Travel between permanent workplace and Sharpsuit PLC customers, 9,200. And then travel between home and a temporary workplace for 1 month is 1,300. Now, the question requirements is what effect will the use of her car for business purpose have on the employment income over here? Okay. Now, if I, go towards as far as the calculations are concerned, I'm going to do the calculations over here and then I'll copy paste over here. Now, when you have the private car for business use, the business miles, they are normally calculated where you travel from the business to your client or something. The commute from home to the office and from office to the home is a private journey. It's not, a business related one. If you travel from the home to a temporary workplace or something, then that is a business journey. I mean, the law is something that we have to understand first. If you go from your home to your office, or you come back from your office to your home, that's a private journey. But while being at the premises, you have to move around over here because of the business. That's going to be the business mile. If you have to go to a temporary, workplace or something, that is going to be a business mile as well, right? Okay. So just 1 second, please. Okay, I'm back. Sorry for the delay. Actually, we just have this environment gift of the smog over here. So it's just that we all have this, sore throats and the allergy attacks. Okay, anyhow. Now let's start. So I was talking about this one over here, the Kim. She's gonna have, we'll have to calculate as far as the business miles are concerned. So basically the travel between the permanent workplace and the shop suits PLC. My business travel miles are going to be 9,200 over here, and then I have temporary workplace. That's gonna be 1,300 over here. So total business miles are going to be 10,500 over here, right? So amount reimbursed is 10,500 into, she received 36 pence, right? So 36 pence, that's gonna be 3,780 less approved mileage allowance. So for the first 10,000, you have 45 pence. And then for the over and above, you have 500, you are going to get the 25 pence over here. So you had 10,000 into 45, and then 500 into 25, that's going to be at 125. So the allowable deduction, 8. Okay. Allowable deduction, which is allowed to you because, as the question said, this is the allowable deduction that you're going to have. All right, so this is something which is going to be allowed to you because you had a lesser one over here. So I need to find this allowable deduction, and the amount is 845. So this over here, correct option A over here. What is the taxable benefit in respect of the loan? Okay, so point number 2. On 1st June, the Shortsuit PLC provided came with a loan of 14,600 at an annual interest rate of 0.75, so she could purchase a new car. Now, the official rate of interest is 2.25%. I mean, if you have read the tax table, so the official rate of interest is 2.25% over here. So interest payable is, loan is 14,600 into 2.25% into, we got it on June. So we didn't have the loan in the April and May. The year start is the 6th April now. So May, and in April we did not have the June, but the rest of the months we had. So it's going to be 10 by 12. So it's going to be 2.25 into 10 by 12. We get this 2.274 less interest actually paid. So 14,600 into 0.75% into 10 by 12. We get 913 over 0.75. So I got it at 7.5. 0075. So 91 is going to be deducted, and then the taxable benefit is going to be 183 over here. Here we go. This 183 is going to be the answer over here, right? Okay. Then what is the taxable benefit in respect to the purchase of the television from the shop suit PLC? So we got a television as well. So on 6th April, Kim purchased a television from the shop suit PLC For 50 pounds, when its market value was 200 pounds, the company had purchased the television for 800 pounds on 6th April 2023, and Kim had used it at home since that date. Oh, where are we? Where are we? Okay, here we are. So we had used the at the home since that date over here. So basically, if we talk about as far as the television is concerned, this is going to be, we have to look at the value, which is going to be the higher of the market value when gifted or the market value when it was first available for you. Simple, right? And the market value when it was first available for use, we are going to less the use of the asset benefit from there as well. So let me do the TV thingy over here. So we have the, for the TV, higher of market value when gifted, that is market value is 200, or the market value when first made available. That was 800 because they purchased it for the 800, then we are going to use the less use of asset benefit according to the 20%. So we got it on 6th April 2023. So 1 year is gone. So this is gonna be 800 into 20%. So the net benefit is 640 over here. So technically speaking, if I look, this is the net benefit less the price paid. We paid the 50 pounds. So the taxable benefit is 590 over here. Okay, so this is what we have. There we go. So this 590 is gonna go over here. Now, what is the amount of the Kim's taxable income for the tax year 24-25 over here? So now we have to calculate the taxable income. So let's just go over here. Taxable income straight. The employment income above benefits, including the above benefits of deductions, is 25,650. Right? And then we are going to have we had this interest paid over here. Right? When we have the interest paid, now remember the the loan was basically used for as far as getting a qualified asset is concerned now. So getting a car for the purchase, that is going to be a qualified expenditure basically, right? So this is going to be the eligible basically interest over here. So we are going to have the eligibility of the interest. Just okay. Done. Now we had this 274 over here. So the taxable benefit was the 183 over here. Okay, so we have the relief on interest which we have paid. So the amount is going to be 140 over here. So the net income that you're going to have over here is going to be 25510. From this, simply minus the personal allowance, which is 12,570. So you are going to get a taxable income of 12940 over here. So okay, taxable income is 12,940. Option A. Now, assuming that the Kim and Richard make a marriage allowance election in respect of the tax year, match the correct option for each individual. We have a Richard over here as well. Okay, this is the Richard. Richard stays at home and look after their children while the Kim is at work. Richard's only income in the tax year was a saving income of 11,700 over here. Okay, so basically we just have this 11,700 over here. So the marriage allowance, the fixed amount at the end of the day, netting off as far as from the tax and everything is concerned, right? That is going to be the maximum benefit which we are going to get is of the 252, right? So overall speaking, personal allowance reduced by 870, no, personal allowance reduced by 1260. So it's as far as the Richard is concerned, Richards, because it has to be transferred from the Richards. Total income 11,700. Personal allowance is 12,570. So the balance is 870. So yes, Richard's personal allowance will reduce by 870. Okay. And but this is from the this is 12,570 over here now. But again, if we talk about if we have a lesser amount over here now, the rule has changed and the rule is simple that now you when you do a transfer of as far as the personal allowance is concerned, the fixed amount of transfer is 1260. So personal allowance is going to reduce by 1260 of the Richards over here, not by the 870, because now in the current Finance Act, we have a fixed amount for as far as the annual transfer allowance is concerned, and that is 1260. So Richards allowance is going to reduce by 1260, and then the net effect is basically the income tax liability. So the KIMS net income tax liability, it is going to reduce by 252 over here. So this is what we are going to have over here, right? So basically, the KIMS income tax liability is going to reduce by 252 over here. This is what we're going to have over here. Okay, right? Now, moving ahead from here, let's see, we have the next question, and that is Kazu over here. So this relates to the 5 requirements as well. Again, this is related to the section B, which we already have over here. And if we look over here, you should assume that today's date is March 25th, 2024 over here. And the tax rates and allowances for the tax year 24-25 apply throughout over here. Okay. Now, we have 3 alternatives over here. Okay, and then we have the requirement assuming that Kazu withdraws the entire net of tax profits of the Zaku Limited as a dividends. Alternative 1, calculate for the tax, the corporation tax liability of the Zaku, and calculate the income tax payable of the Kazu in respect of his dividend income as well. Okay. Now let's just go and start. Kazu is currently employed at a gross annual salary of 200,000. Kazu will continue to earn the same salary until he retires on 5th April 2028, at which point basically his income will reduce to gross annual pension income of 55,000. So at the moment he is having a gross salary of 200,000, and on the 5th April 2028, when he's going to retire, he's going to go on to the annual pension of 55,000 only. This means that Kazu is currently on additional taxpayer, but will only be a higher taxpayer when he retires from the 5th April. Kazu will undertake 40,000 pounds of work on a freelance basis during the year ended 5th April 2025. To carry out this work, Kazu will form a new limited liability company, Zaku Limited, of which he will be an employee. This freelance work will not involve any expenditure and will last for just 1 year from 6th April to 5th April. And Zaku Limited will prepare accounts for the year ended 5th April 2025. Kazu is looking for the three alternative ways of extracting the profits of the Zaku Limited. Number one, after allowing for the corporation tax, Kazu will withdraw the entire net of the tax profits as dividends during the tax year 24-25 over here. Okay, now if he goes with the dividend, so we have this point number one over here, that we have to calculate the corporation tax liability, and then we have to calculate the income tax payable by the Kazu in respect of this dividend income over here, right? So technically speaking, uh, overall speaking, we will simply calculate as far as the corporation tax liability is concerned, and we'll see at the dividends how the workings are to be done and all, right? So the amount is the 40,000 over here, right? So I can simply say the Zauku Limited corporation tax liability is 40,000 into, let me paste the rate of tax for you guys over here. Here we go. This is for the reference only. So we have the small profits over here. So the rate of tax is 19% over here. So that's going to be 40,000 into 19%. So that's going to be 7,600 over here, right? So we are going to have the corporation tax liability of 7,600, and the total dividend income for the Kazu will be 40,000 minus 7,600, and that's going to be 32,400 over here, right? So the working number one, I mean, I'm going to cut it from here. I'm going to paste it over here. Now, the first working, which was to calculate the corporation tax liability, this is done. Now we have to calculate the income tax payable over here. Now, as far as the dividend income and everything is concerned, Zaku, no, Kazu. Kazu will receive CEIVE, receive dividend income of 32,400, right? Now, the income tax payable will be, we all know that the first 500 is something on which we don't have to, pay the tax. On the remaining amount, this is the higher band over here, Now, if I go up here, this one, yes, this is the personal, this one different. So I am currently into the additional now, so 39.35% because my earnings are really very high, so I'm gonna have this 39.35%. So 39.35%. So that's gonna be 32,400 minus 500 into, this is gonna be 12,553. So my income tax payable is going to be 12,553 over here. There we go. Right, so that's gonna be 12,553 over here. I hope it's clear to you. Part B. Explain the corporation tax, income tax, and national insurance contribution implications of the alternative two. Okay. Assuming that Zaku Limited will pay Kazu gross director's remuneration of 8,000 and Zaku Limited will make a pension contribution of 32,000 into the company occupational pension scheme on Kazu's behalf during the tax year. Okay. We have quite an interesting situation over here. Zaku Limited will pay Kazu's gross director remuneration of 8,000 and Zaku Limited will make a contribution of 32,000 to the company's pension scheme on the Kazu's behalf. Kazu has sufficient unused pension annual allowances so that a pension contribution of this amount will not result in an annual allowance charge over here. Okay. So we still, have over here. Now, as far as from the company's point of view, the director's remuneration and the pension costs are concerned, these are the allowable deductions for the company, right? So technically, the total taxable profits from the company's point of view, I mean, if I go over here, that's going to be zero, right? Why? Because from the corporation tax point of view, if I go, paying the director's remuneration and the pension contribution will automatically reduce the taxable profits, right? Now, the amount of the profits at the moment is what? 40,000 minus 8,000 remuneration minus 32,000. It said that it will pay a contribution, right? So when it's gonna pay all of these, so the corporation tax is gonna go at the zero over here. Second one is the income tax. Now, for the income tax, Kazu will pay income tax of 8,000 into the higher bracket, and that is the 45% because we are into the higher one now, the addition. Not the higher, the addition. That is going to be 3,600 over here, right? Because the pension contribution, that's exempt, so that's not going to have any impact over here. And then it's asking and national insurance contribution implications, NICs over here. Now, if I go into the NICs over here, now the class one for the employee, if the earnings are between 1 to 12,570, and that's only paying the NIC, so overall speaking, if I talk about from the NIC point of view, the class one NIC is not gonna be there because my earnings, they are below 8,000, right? This is below the threshold over here. They are 8,000, huh? So they are below the threshold over here, right? So if the earnings are on the lower side, I'm not going to have anything over here from the tax point of view. And as far as they are received from a different employer, right? So they are going to be accounted for separately over here, right? So I am not going to have any complication for as far as the contribution, NIC contribution is concerned, right? So that's going to be 0 as well. Then 1 entirely as dividend. For the entirely as dividend, in the alternative one, we thought about that if I get the whole amount as a dividend. Now, if I go B2, the tax saving will be. Now, I have this 7,600 over here, right? And this income tax over here. Done. So, no, this is not the tax saving. The total tax payment under alternative 2 will be, I have the corporation tax liability of 7,600. I have income tax payable of 12,553 over here, right? And then I am going to have this what else am I going to have over here? And over here, the income tax was 3,600, right? Of alternative 2 compared to the alternative 1. So over here, the income tax. Okay, I am lost a bit. In the first one, I was withdrawing all of the profit, so that was a total of 3,600 payments. Over here, I will have to pay this 7,600. Then I had to pay 32,400 over here as well. So 7,600 has been paid. 3,600 has been paid. Now less this 3,600. That is 3,600 now. So net saving is going to be, yes, this is going to be 16,553 over here. Right? So my net saving, calculate the tax saving that I have over here. This one. This is going to be, my savings over here. You're not expected to explain the tax complication. Okay, we haven't done anything. Now the part C, calculate the tax saving in respect of the Kazu's dividend income and Zaku's limited corporation tax liability if Kazu withdraws the entire net of tax profits of the Zaku as dividend during the tax year 28-29. Alternative 3, when Kazu has retired rather than during the tax year 24-25. Okay. Now, if we keep on holding the profits until the Kazu retires, yeah, this is something gonna be a good thing over here. So the net income of, or net income, net profit after tax of the Zaku Limited will be, we had this where is the calculation for the Zaku that I did? Okay, let's just go back. Entire amount as the dividends, now the entire amount. So this was the 40,000 over here. So with the 40,000, I just simply had to pay up the amount. Yeah, this one, corporation tax liability. Okay. So that's going to be 7,600 over here, the tax that I'm going to pay over here, right? Then for 28, 29, when the Kazu will be retired, he will be a higher taxpayer. So the tax on dividend income will be, now I have this 40,000 minus 7,600 minus 500, the relief that it has. It's going to be multiplied with 33.75%. So 40,000 minus 7,600 the corporation tax, 500 for the dividend allowed, 3,375. I get this 10,766 over here, right? So this is what I am going to have over here. So I have to compare it with the alternative one over here. So total saving here will be, the amount of tax that I have to pay over here is 10,000. Over there, the amount of tax, the total tax I had to pay, it was 12,553 over here. So 12,553 minus 10,766. So I have 12,553 minus 10,766. I get a total super saving of 1,787 over here, right? Okay, so this is what we have over here. Now, let's have a break for 4-5 minutes only, right? Let's just get up from our seats, walk around a bit. We're gonna come back and then we are gonna resume. Let's have a break. So let's assume now. We have this question number 102 now. This scenario relates to four requirements. So you should assume that today's date is 4th April. Now you have paragraph number 1, 2, 3, then retain the inherited shares. Then we have this information. And this is a 10-mark question. Okay. Now, the start is on 2nd April 2024, Kagan inherited some quoted ordinary shares valued at 510,000 from following the death of his aunt. Kagan is unsure whether to retain the shares or sell some of them in order to make some alternative investments. Kagan is aged 61 and is an additional taxpayer. Prior to the inheritance, his taxable income consisting entirely of the employment income for the tax year 24-25 would have been around 400,000. Okay. The income tax liability of this income for the tax year would have been around 166,203 over here. Prior to receiving the inheritance, Kagan's chargeable estate for inheritance tax purpose was valued at 1.7 million. Inheritance of this 550,000 would be payable were he to die in the near future. Okay. Now, retaining the inherited shares. If Kagan simply retains the inherited share, then he will receive dividend income of 15,300 during the tax year 24-25. This is in addition to his employment income of 400,000. Sell some inherited shares and make four alternative investments. Kyle is considering selling some of his inherited shares, for which there has only been a minimal increase in value since he inherited them, to fund the following four investments, all of which will be made at the start of the tax year 24-25 over here. So we have these alternative investments as well, which we can, you know, do over here as well, right? So we have this 1, 2, 3, 4. And after making these four investments, Kagan will be left with 65,000 of the inherited shares, on which he will receive the dividend income of 450 during the tax year 24-25. And he will also have his employment income of 400,000 as well. And Kagan will not make any other disposal during the year. So calculate the Kagan's revised income tax liability for the tax year 24-25 if he retains the inherited shares. So if he plans to retain, then okay. If he plans, so we can simply say that Kagan's revised income tax liability for the year will be we have the current income tax liability, which is at 166,203. And then we are going to have the, if it's going to inherit these, we are going to have the dividend income of 15,300 over here. So we have this dividend income now, that is 15,300 minus 500, irrespective of whatever the tax rate you are, and then the maximum limit is the 13.35. So that's going to be 15,300 minus 500 into 0.3935 over here. So that's going to be 5824 over here. So the total is going to be at 172,027 over here, right? So if somebody asks me that what is going to be my part A, so that is how we are supposed to solve the part A over here. Then the part B of the question, explain why little or no capital gain tax will be payable if Kagan sells some of his inherited shares over here. Now, why little or no capital gain tax? If I go up, Kagan is considering selling some of the shares, and it also said, I read somewhere, for which there has only been a minimal increase in the value since he inherited them. Since he inherited them, right? So technically speaking, the base cost of the shares will be their value at the time of his aunt's death, right? So the minimal increase in value is likely going to be covered by the annual exempt amount over here, right? Because this statement over here, now this is the one which is giving us an idea over here that for which there has only been a minimal increase in value since he inherited them. So basically, the base cost of 10,000 will be used. Minimal increase is automatically covered by the annual exempt amount of 3,000 because minimum increase is over there. So it's going to be covered up by that amount as well, right? Okay. Now, the next requirement, calculate the Kagan's revised income tax liability if he sells some of his inherited shares and makes the four alternative investments. Now, notes. For this part of the question, you are expected to produce a full income tax computation. You should indicate by the use of the zero for any items which are not taxables. Acha, which are not going to be taxable. So we have to create a full-fledged working over here. So this is going to be B2. Part B, and then 2 over here. So we have this Kagan's income tax liability for 24-25 over here. Now we have employment income. The employment income is straight at 400,000, right? And now, okay, number one, Kagan will make a gross personal pension contribution of 100,000. Kagan is a member of a pension scheme but has not made any contributions in the recent years because his income has been substantially lower than it has for the tax year 24-25. He therefore has sufficient unused allowances to cover a pension contribution of 100,000. Kagan will immediately withdraw 25,000 of the pension fund tax free. Okay. And this is permitted. This is the permitted 25% tax free lump sum amount. However, no pension will be taken during the tax year 24-25 over here. Now, the point is, overall talking about the pension contributions, right? This one over here, gross pension contribution is over here. Now, so the pension amount, that's not gonna bring in any effect whatsoever is concerned, right? And then Kagan will invest 50,000 in the premium bonds. The expected amount of the premium bond prices which will be received during the year is 700 over here. Now, as far as the bonds are concerned, the premium that we have, technically speaking, they are after tax, right? So we don't have to take them over here. So premium bond price, that's gonna be 0 as well. Then third one, Kagan will invest in the maximum permitted amount of 20,000 as cash individual saving account. Individual saving accounts, they pay interest of 400 for the tax year 24-25. The interest from ISAs, they are exempt basically. So we don't have any issue whatsoever for that as well. And then Kagan will purchase freehold property for 295,000, including all the cost of purchase. The property will be let out furnished, and the Kagan will receive the property income of 9,600. So we have a property income of 9,600 over here. And then after making these four investments, Kagan will be left with 65,000 of the inherited shares on which he will receive the dividend income of 450. Okay, so we are now going to have the dividend income of 450 as well. So total income is going to be 410,050, right? So as far as the personal allowance is concerned, that's going to be 0. So my taxable income over here is going to be 410,050 over here, right? Okay, now as far as the income tax is concerned, I am going to have the workings for the income tax over here, and the workings are going to be straight away simple and straightforward over here. I have this employment income over here for 400,000, right? So this is going to be for the first 37,700. The rate of tax is 20%. So this is 37,700 into 20%. That's going to be 7,540. Then for the next 100,000, this is going to be at 20% as well. So that's going to be simple 20,000 over here, right? And then the next one is the 87,440 over here, right? For that, that's going to be at 40%. So 87,440 into 40%, I am going to get 34,976 over here, right? So overall, if I do the calculation up till this point, I have 37,700 plus 100,000 plus 87,440. I have a total of 225,140 up till now over here, right? So this is going to be over here up till this point, and then I am going to have my next point over here, and that is I have a total income of 410. I'm going to less my dividend income because dividend is within the first 500 now. So there's no issue with that. So the amount left is 410,050 minus I am going to have this 225 which has been charged, then minus 500 for the dividend, right? So I am going to have this 410,050 minus 225,140 minus 500. I'm gonna have this 184 over here, right? So I'm gonna have this 184 410 over here, and 410,050 minus Oh, sorry, I have minus the 500 over here. The amount is 450. So the amount is 450 over here. Okay. Now with this one, I am going to have the rate of tax at 45%. So 184,460 into 45% is going to be there. And then we have the dividend at 450, which is taxed at 0. So we'll have the 0 over here, right? So total, the income tax liability that I have, it's going to be at 145,523 over here, right? So that's going to be straightforward over here, right? Now, if you look, I have I have included this 100,000 over here, and none of you asked me that why I had this 100,000 over here with the 20%. Although my basic rate is 37,700 into the 20% now, but why I had this 100,000 over here as well? Why? Because I am making the contributions of 100,000. So whatever the contributions I do, they are going to extend my, the basic and the high rate bands over here, right? So because of the the payments over here, my basic band has increased over here, right? So that is why I had this 100,000 extra over here. Done. Okay, next one is for the part C. For each of the four alternative investments, pension contribution, premium boards, and the freehold property, state whether the investment will reduce the Kagan's potential inheritance tax liability compared to him retaining the inherited shares. Okay. Now, as far as the question is concerned over here, it's asking that four alternatives that I have over here, 1, 2, 3, 4, right? So what impact they are going to have, overall speaking, uh, the inheritance, potential inheritance liability, what is going to be the impact on that? Now, if I talk about, so I can simply say the amount which has been invested into the pension, they are going to be outside the Kagan's state. Basically, that is something which doesn't have any concern with as far as the inheritance tax is concerned now, right? So technically speaking, that is outside the Kagan's estate. So that is technically speaking going to reduce the potential inheritance tax liability over here, right? And then the investment in the bonds which has been done. If I talk about the bonds, if I talk about the interest saving accounts are concerned, the freehold property is concerned, it's not going to concern, or it's not going to be linked, or it's not going to have any impact whatsoever on the inheritance tax liability is concerned, because one asset is simply being replaced with another asset of the equivalent amount and all, equivalent value and all, right? So it's not going to have any impact whatsoever on to as far as inheritance tax is concerned, right? It's not going to have any impact whatsoever on that is concerned. Okay, now moving ahead from here, if I talk about this one, okay, this scenario relates to three requirements. This is of the ESME. If I go down, this is a 15-mark question, right? So typically related to as far as the income tax is concerned. So let's just format ourselves as well, because okay, so we're gonna have this as well. Now, calculate the ASME's income tax liability for the tax year 24-25. You should indicate by the use of the zeros for any items which are not taxable or not deductible. Okay, so along full-fledged question we have over here. So we have this part A. This is the ASME's income tax liability for 24-25 over here. Is employed by the HHK PLC. So this is from the employment income. So we have the non-saving, we have the saving, we have the dividend, and then we have the total. Okay, so this is the saving. Now, we'll start from here. ASMES employed by the HHK PLC, the following information is available. HHK PLC paid ASMES a gross annual salary of 45,000. So we have a salary 45,000. Right? Okay. Then after the salary, during the tax year 24-25, ASMES received a bonus of 19,000. Right? On 10th April 2024, another bonus, and then another bonus of 22,000 on 22nd March 2025. ASME was contractually entitled to receive these bonus on 31st March 2024 and 31st March 2025 respectively over here. So now we have the calculations for as far as the bonus is concerned, right? What we can do over here for as far as the bonus is concerned, we have to see that when we have actually received the amounts, amount over here, right? So if we look, the first one, 19,000 bonus is received on 10th April 2024 over here. So basically our tax year, it has to go from 24-25, from 24 to 25. Now, okay, so we have this one over here. And then we have received another bonus on 22nd March 2025. Okay, ASME was entitled to receive these bonuses on 31st March 2024 and then the 31st March 2025. So this bonus, this is related to the previous year, whereas the 22,000 of the bonus, this is related for the 31st March 2025 in the current year, right? So over here, bonus one for 19,000, I am going to have 0 over here, and then bonus 2 for 22,000, I will have the bonus over here, right? I can have this bonus 2 over here. So this 0, this 22,000 over here. Done? Okay, then the point number 3, during the period from 6th April to 30th November, ASME was provided with a petrol company car. The car has a list price of 42,000 and official CO2 emission rate of 178 grams per kilometer. ASME was not provided with any fuel for private journeys. Okay, now I am going to write this as car benefit with working 1. I'm going to go into the workings over here. That's going to be working 1 car benefit over here. Now, the car benefit is going to be, the basic is 16%. No, I have to show it with the percentage. Okay. So it's not showing now. The basic is 16%. And then I have this emission of 178 grams minus 55 by 5. So 178 minus 55 by 5, I get this at 25% over here, right? So this is 25% as well. So total is 16 plus 25, 41%, right? But limited to 37%, right? Because we can only have the limited amount up to 37%, right? Now, 6th April to 30th November, right? So total value of car is 42,000 into 37% into April, May, June, July, August, September, October, November, right? So I have this 8-month use over here for the car. So that's going to be 8 by 12 as well. So 42,000 into 37 into 8 by 12, I get 10,360 over here, right? So the benefit for the car, which I am going to have, is going to be 10,360. 10,360 over here. Then, okay. Then I have point number 4. On December 1st, 2024, Emma purchased her own car for 20,000. During the period from 1st December to 5th April, Emma drove a total of 23,000 miles, of which 12,000 were for the business journeys. HHK PLC reimbursed ASME 5760 for the business journeys over here. Now, I am going to have my second working over here for the mileage allowance for the car. So this is the car benefit. Mileage allowance. So mileage reimbursement. $5,760 less approved mileage allowance. 23,000 miles, right? So 12,000 are for the business journey. So 10,000 into 45 pence. 2,000 into 25 pence. 500. Total is 5,000, right? So I am going to have mileage benefit deductible. Not deductible, sorry, mileage benefit taxable, because my reimbursement has been higher. So that is going to be taxable over here, right? So I am going to bring in my mileage allowance, and that's going to be 760, this one, right? Okay. Then ASME contributed 4% of her gross salary into the HHK's occupational pension scheme. HHK contributed further 2% into the pension scheme for the SME's behalf. So I have my SME's pension contribution. So I have paid 4% of the salary now. So 45,000 into the 4% is 1,800. I'm going to deduct from here. And then the HHK PLC pension is going to be 0 over here, right? Okay. Then we have the other information over here. During the tax year, Asma received dividend income of 6,000 from quoted shares. Asma is considering transfer these shares to her husband Andy. Now I am going to put in this as total employment income like this. Now I will write dividend income 6,000 over here, right? Okay. And then Ashma made a charitable donation net under the gifted scheme. Okay, this is something we are going to have at the end. So we are going to have the less personal allowance, 12,570, 12,570. So we are going to have the taxable income. Here we go. 6,000 here, and over here we are going to have a total amount over here. 69,750 over here. Okay. Right? Now, we had to calculate the income tax liability. Okay, so we have to calculate the income tax liability, so we have to take them a bit down like this. Now, I am going to write income tax liability over here. So we are into the 63,750. So I am going to have my basic 37,700 over here, right? And that's going to be with the 20% over here. So that's going to be 7,540. Then I made a contribution. Charitable donation of 5,000 net over here, right? So net amount is 5,000. So my band is donation and okay, let me write it as basic band increase. And this is 5,000 net over here. 6,250. So basic band increase. 6,250 into 20%. That's going to be 1,250. Right now, for the remaining amount, higher one is 63,750 minus 37,700 minus 6,250. Uh-oh. And this is gonna be multiplied with 40%. So 63,750 minus 37,700 minus 6250 into 40% is going to be 7920. Then for the dividend income for the first 500, that's going to be 0. And then for the 5,500, we are going to have the additional rate of 33.75%, right? So that's going to be 5,500 into 0.3375 over here, 1856. So total income tax liability 18,566. Right, so this is what we are going to 18,566 is what we are going to have over here. Done. So this is the point A, which we have solved over here. Now, let's go to the part B over here. Explain how a married couple can reduce their income tax liabilities for the tax year 24-25 by claiming the transferable amount of the personal allowance, the marriage allowance, and state why such a claim is not possible for Asman and Andy. Now, as far as the explanation is concerned, we can put up the multiple points over here that normally the transferable amount of the personal allowance is 1260, right? And this is going to reduce the personal allowance of the spouse of the partner making the transfer, right? And this is going to reduce the personal allowance by 12,570 minus 1260. I mean, you can write it like this. Let me show you. We have part B, the amount of personal allowance transferable is 1260, and it reduces the amount of personal allowance of the spouse or partner making the transfer from 12,570 minus and wait. The amount of the personal allowance transferable is 1260 and reduces the amount of the personal allowance of the spouse or partner making the transfer to 12,570 minus 1260 is 11310. 11310, right? Then the second point that we can add up is the total income tax liability of the partner or spouse getting the allowance will reduce by 252 only. That is 1260 into 20%, right? Now, a claim of transfer of this marriage allowance is not possible here with Asma and Andy. With Asma and Andy, because the Asma is a higher tax payer. In order for her to avail the marriage allowance, she should have had her total earnings falling in the basic tax band. Right, so that's not going to be possible by her. Now, explain how both Asma's income tax liability as Andy's income tax liability for the tax year would be affected if they were to transfer all the quoted shares held by ASME to Andy. Okay, if all the shares were to be transferred. So we have part C over here. Okay, now if I go over here, ASME, this is the ASME is married to Andy and his only income for the tax is the dividend income of 7,000. So both ASME and Andy income is expected to remain the same for the foreseeable future. Now, I have ASME's earnings. I have Andy's earnings. This is 7,000 already over here, right? So transfer from ASME's, that's gonna be 6,000 over here, right? Okay, so technically speaking, this is 6,000 over here. We'll minus the 6,000 from here, right? So as income tax liability of Andy and ASME is going to be affected now. Now, if I make it transfer, so technically speaking, this is going to be partially relieved by the Andy's personal allowance of that 12,570, right? And the remaining amount is going to be covered by the dividend nil rate band over here, right? And ASME's reduction in tax liability is into 33.75%, which is going to be 6,000 minus 500 is 5,500 into 0.3375. So 1,856 is going to be saved over here, right? So this amount is the total saving if they do over here, because over here the total amount is going to be 13,000. So the personal allowance is 12,570. So remaining is going to be 430. So dividend minus 500, we are left with nil amount over here, right? Okay, let me show you. So we have a nil amount over here. So technically, if it makes a transfer of the shares to the Andy, then the tax saving of 1,856 can be achieved over here. So the tax saving that you can have over here is of 1,856 over here. Done? I hope it's clear. Okay. Now we have the next question for the Tony. Okay, just 1 minute and we are starting 1 minute. Okay, so Tony, this scenario relates to three requirements. Up to and including the tax year 22-23, Tony was a resident in the UK for the tax purposes, spending more than 300 days in the UK each year. Tony understands that for the tax year 24-25, she will gain automatically again. She will again automatically be treated as a resident in the UK, but is unsure of her resident status for the tax year 23-24. For this tax year, Tony was neither automatically resident in the UK nor automatically not a resident. Throughout the tax year 23-24, Tony was traveling around the world and did not stay in any one country for longer than 30 days. Although she spent a total of 50 days in the UK. Now, Tony has a house in the UK, but it was let out throughout the tax year. She's single, has no children, and stayed with a friend on the 50 days that she spent in the UK. Tony did not do any substantive work in the UK during the tax year 23-24, and then the following information is available for the tax year 24-25. We're gonna stop over here because this mess, like how she actually stayed. This is something which is going to ask us a question over here. So I'm gonna go down. Explain why Tony was treated as not resident in the UK for the tax year 23-24. See, I told you that we are going to have a questions requirement over here. If I go up again, now the issues. Tony was traveling around the world and did not stay in one country for longer than 30 days, although she spent a total of 50 days in the UK. She has a house in the UK, but it was let out. It was let out. She's single, no children, no tears, no bonding over there back in the UK. And she stayed with a friend on the 50 days she spent in the UK. And she did not do any substantive work in the UK during the tax year as well. Now, technically speaking, Tony was previously resident in the UK, right? I mean, because technically she was over there between the 46 to the 90 days, right? So she therefore needed how many ties basically she's gonna need over here. So let me bring this up for you over here. Here we go. We need to look at this thing. This is gonna be in the tax table as well. Here we go. She was previously a UK resident, nah? Previously a UK resident. So if you have spent 46 to 90 days, because you have spent 50 days over here, so it's gonna be resident over here if 3 UK ties or more are met over here. 3 UK ties. Now, if I look over here in this question, the point is, how many ties do we have over here? Spending more time in the UK than any other country during this year. If we see, we have spent not longer than 30 days in the other countries, but in the UK we spent 50 days over here. So one tier is met. Second one is um she was over there for more than 90 days during the previous, you know, overall speaking in the UK, right? Because previously she was the resident now. So technically she was spending more than 90 days over there in the UK, right? So if she has spent more than 90 days, so this is one tier met as well. Second tier is she spent extra time in the UK than any other country as well, but no other point has been met over here. No other point has been met over here. So technically, she can't be regarded as a resident over here, right? Okay. Now, the second point, list 4 factors which are indicators of Tony being treated as employee in relation to her contract with the Droid PLC rather than as self-employed. Just give me 1 second, please. Just 1 second, please. Okay, I'm back. I'm so sorry for the hold. So we're talking about this one over here, the Tony. We have the other income. Okay, so we were talking about the list four factors. The Tony being treated as an employee in relation to her contract with the Droid PLC. So where is the Droid employment? This one over here. On 6th April 2024, Tony, who is a software developer, accepted a 1-year contract to maintain the websites for the Droid PLC. Droid PLC treated the contract as one of employment, with the payments to Tony being subject to pay. However, Tony thought that because she was working from home, her employment status should instead have been one of self-employment. Okay. Uh, for the term of the contract from 6th April to 5th April, Tony was paid a fixed gross amount of 6,200 a month. During the term of the contract, Tony was not permitted to work for any of the clients. She was required to do the work personally, not being permitted to subcontract the work to anyone else. During the term of the contract, Tony worked from home but had to attend weekly meetings at the Droid PLC offices to receive instructions regarding the work to be performed during the following week. During the period 6th April to 5th April, Tony used her private car for the business visits to the Droid PLC clients. She drove 2,300 miles, for which the Droid PLC paid an allowance of 60 pence per mile. During the term of the contract, Tony leased computer equipment at a cost of 180 a month. This was used 100% for business purposes. Okay, so this is the employment thingy over here. Okay. Now, this is related to what we have for the employment basically over here, right? So now the point is list four factors which are indicators of Tony being treated as employed, in relation to her contract with the Droid PLC, right? Rather than as self-employed over here. So you should confine your answer, sorry, to the information given in the question over here. Okay. Now, the first point is, we can go over here, part B. The contract is for whole year. Technically, long period of time, which shows that it's an employment, right? Then there is no risk factor for Tony, indicating she is employed. Then during this period, she only worked for one uh, company only, was not allowed to work for others, had to do the work personally, couldn't outsource it or delegate it to someone else, right? And then Droid PLC instructed her on weekly basis on what to do next and gave instructions, right? So these are the points basically which are giving us the idea that the Tony was basically self-employed over here. Now, on the basis that the Tony is treated as employed in relation to her contract with the Droid PLC, okay, calculate her taxable income. Okay, so now I'm gonna go in the part C. This is going to be the Tony with the taxable income 2425 over here. So we have employment income first. So we have this 6,200 a month. $74,400. Then Tony worked from home but had to attend the weekly meetings and she got 60 pence per mile. Now, mileage allowance, business mileage allowance are 2,300 miles into she was given 60 pence but is allowed 45 pence by the standard. So she will have a difference of to be taxed, right? So she's going to be taxed over here for this amount. Then she got a computer for 180 a month for lease, and this is used for business. So computer leasing cost allowed 180 a month. So 12 months, I get 2160, right? Sorry, this is allowed. This is allowed. So I'm gonna minus this up. Then I am going to have, okay, this is the employment income. Now I am going to have my property income as well. As far as the property income is concerned, okay, this is the other income. So property income is going to go into the working. So property income, working one. I have the workings, working one, property income. Tony owns a freehold house which it let out. This is not furnished holiday letting. The amount of the rent received during the year was 10,080. Rent received 10,080. Then I have Tony partly financed the purchase of the property with a repayment mortgage, paying a mortgage interest of 4,200. Okay, so this mortgage interest is concerned, technically speaking, the mortgage is not going to attract any relief whatsoever is concerned, because the relief is basically given at the computation time, not in the income, basically, right? So this mortgage interest is going to be zero over here. Then during the May, Tony purchased a new washer dryer for the property at a cost of 640. This is a replacement for an old washing machine which was scrapped. With the nail proceeds, the cost of the similar washing machine would have been 380. Okay. Which was scrapped. The cost of the similar washing machine would have been 380 over here. So overall speaking, as far as the washer dryer is concerned, this is an improvement, right? So the relief is going to be restricted towards the amount for the original, that original which would have costed, right? And okay, so this washing machine is only going to be 380. Then we have a dish washer over here. She got the dishwasher at a cost of 560. The property did not previously have a dishwasher, so zero. We cannot have, like, the relief on something we didn't have before. The replacement relief is allowed. The other expenditure on the property for the tax was amounted to 1110, and this is allowable. Other expenses. Other expenses are 1110. Right? So we are going to have a total over here of 8590. Then During the tax year, Tony rented out one furnished room of her main residence. During the year, she received a rent of 8580 and incurred allowable expenses of 870 over here in respect of the room. So furnished holiday accommodation, furnished room, sorry, furnished room, we simply have this allowed amount. This is 8580 minus the allowed exemption, that is 7500. So 8580 minus 7500, we'll have the 1080 over here. So total property income is going to be 9670 over here. So property income 9670 is what we are going to have over here, right? And then we have other income over here. On 1st July, Tony inherited 100,000 of gilts, paying interest at the rate of 3%. The inheritance was valued at 120,000. Interest is paid half yearly on 30th June and 31st December based on the nominal value. Tony sold the gilts on 30th November for 121,250, including the accrued interest over here. Now, overall speaking, as far as the accrued income is concerned for the interest, basically, this is what we are going to, have over here. So this is the 3% interest. She got it on 1st July and then she sold it on 30th November. So July, August, September, October, November, right? So we have 5 months over here. So we can say this is going to be the interest on gilts, right? And the amount is 100,000 value over here into 3% into 5 months. I calculated the 5 months right in front of you. 0.3 into 5 by 12. So that's going to be 1250. Then we have on 35th, Tony received a premium on bond price of 100, that is after tax, right? So premium on bond price, that's going to be 0. And then we have Tony received interest of 520 from NSI is exempt. So interest on saving certificate, that's going to be 0 as well. So total income is going to be less personal allowance 12,570. So we get a taxable income of 70,935 over here. I just had to calculate the taxable income. Okay. Right. So this is what we are going to have over here. Right. Okay. So this is what we have. Now, let's just stop over here for the day. Right now, what you have to do is all the questions that we have done today, you are going to revise these questions, right? Get through these questions again. And if you come across any problem or something, feel free to ask me on to as far as the WhatsApp is concerned. Now we are going to meet again on the Wednesday, the day after tomorrow. So meanwhile, just go through these questions, practice these questions again, and obviously we are going to again have a discussion about these, right? So we'll move forward in the next class and then we'll see what other things we have over there. The practice is of the essence, the practice is the key, over here, right? The more you practice, the more you are going to get and the more you are going to understand over here, right? So the group is going to be created, right? So you can contact me over there. Done? Okay, so this is all gonna be for over here. I mean, if you have any question or something, you can ask me. Otherwise, we are done.
Now, actually, I had one question.
Yeah, sure.
For the furnished room, you extracted that 7,500. So how do we get that amount? We had 8,580 minus 7,500.
This is the basic one, which is this is the basic threshold which is allowed in the furnished,
Oh,
the furnished holiday letting basically that we have. Sorry, the furnished room, the room that you do in your main residence. This is something which is allowed.
okay.
Let me see and share this one. Yeah, this one. Rent a room relief. This one. This rent a room relief. This relief is available. This is something which you're gonna see
Oh,
from the
yes, yes, I saw
yeah,
it. Yeah.
yeah. It's available over there in the taxable, right? It's just
Okay.
that,
Yeah. Thank you.
what, yeah, no
Yeah.
problem, no problem. So it's just
That's,
that,
that's
try to go through the tax table again, because I feel, maybe I might be wrong as well, but you're working along with the looking at the tax table. It requires a bit of a practice, right? And because you should be having these points in your mind. I mean, when to look straight away to the tax table rather than memorizing. Because what I normally do in my normal classes while doing the practice, this is something I try to make my, students learn to straight away consult the tax tables when we are into the rates and all now. So this is something you are going to get with the practice and all. Okay, no issues, no hurries, it's okay. We still have plenty of time to practice and to get along as well. And I hope you must have gotten the 40-day planner as well on the academy's portal as well. I mean, on the WhatsApp channels, the coordinator and the other persons, they keep on posting the 40-day planner for the tax as well. So I hope you have that as well, right? So it's going to be beneficial for you. I mean, even if you start practicing from today, it's just that for the first 3 or 4 days, you will have to do a practice a bit fast to bring it down under your target, ultimately for as far as the paper is concerned, right? So just go through that, and then please do let me know if you have any issues or something, okay? So, it's time to say bye. I'm gonna see you a day after tomorrow, same time, same place, same channel. Till then, take care of yourself, your family, your friends, and the people around you, and have a lovely week and a lovely day tomorrow as well. Till we meet again, take care. Bye bye.
Thank you. Bye.